Now let's talk about investing in mutual funds, ETFs, index funds, and even bonds. Now, what are these funds actually? The best way to look at them and to think about them is that you have a pool of different investors' money. That money gets invested into different securities by a fund or money manager. Different securities such as stocks, bonds, commodities, etc., or even a combination of those. Now, the benefit of this is that if you think about it, you might be an investor that does not want to invest in an individual stock. Or you might be an investor that likes to invest in individual stocks, but you need something that's maybe a little bit more safer, maybe a little bit more diversified. That's where these funds come into play. So when you invest in individual stocks, yes, it's extremely exciting because it's high risk, high reward, right? So you can see your stocks shoot up to the moon, but you can also easily see them come crashing down. A lot of investors cannot stomach seeing their investment portfolio dip down by 30%, maybe even 40%. And if you think about it also, when you invest in individual stocks, there's a lot of research that comes into play and a lot of analysis, also called fundamental analysis. This is where you look at the financial metrics of a company to see how profitable that company is. So you might look at the net income that a company generates, the return on invested capital, the return on equity, the gross profits. Investing in a fund gives you immediate diversification. That's one of the benefits compared to investing in individual stocks. So let's say you invest in an ETF that invests in different companies in the tech sector. You have immediate diversification in tech stocks, which you don't have when you invest in individual companies. Or you have an index fund that invests in the companies that are in the S&P 500. You have that immediate diversification. Another benefit is that index fund, mutual fund, even ETF investing is a passive way of investing. When you have to analyze stocks, you're actively doing the research, analyzing these companies. But investing in a fund, it's a more passive way of investing because you have a bunch of money that you just put into your brokerage account, and at the right time you just put money into that, into buying that ETF, index fund, mutual fund, etc. Another benefit of investing in a fund is that the research has already been done for you. And the research is also still being done by the fund manager to make sure that the correct companies are in that fund that you're investing in. This makes it extremely easy because all you have to do is make sure that you're investing in the correct fund. Now, in order to get that confidence to know that you're investing in the correct fund, you need to look at the track record and the history of how that fund has performed. That will give you the confidence to make sure that that fund will perform well into the future. Now, the future is always unpredictable, of course, anything can happen, but looking at the history and also looking at the fund manager's performance, how long has the fund manager been in the business, how many different funds is he or she managing, that will all give you the confidence to make sure that yes, this is the fund that I want to invest in. So some of the disadvantages of investing in a fund is that you're pretty much taking your hard-earned money and you're giving it to a fund manager and you're telling the fund manager, here, go ahead, take my money and invest it. And for that privilege, you will pay the fund manager a fee, of course. Some investors don't like that. They still like to be hands off with their investing in individual companies, day trading, swing trading, etc. Another disadvantage of investing in a fund is that you might not pay attention to what you're actually investing in. So there is a list of companies that you will be invested in, but you might not see that full list up front. If you are morally against specific businesses or business practices, let's say you don't like weapon sales or you don't like for profit prison systems or you're against CBD, you want to make sure that the fund that you're investing in is not invested in those companies. Nowadays, with technology, it's pretty easy to get a full list of the companies in a specific fund because all you have to do is go to the company's website, get a full list of the companies in the fund, or you can even request it from the website. You could also go to the SEC website and put in the ticker symbol of the fund and get a list of all the companies in that specific fund. But that's something that you definitely need to pay attention to. If there are some things that you're against, make sure that you're not investing in those types of companies. Even when I look at my investing strategy, I love investing in individual companies. I like doing the research and putting them in my watch list, and I have a watch list of over 50 companies that I keep an eye on, and I buy them whenever they're selling at a discount, whenever the value is there, preferably dividend paying companies. But I also have different funds that I invest in, different ETFs, different index funds. And it makes my portfolio balanced because there's instant diversification when I invest in the ETFs and index funds. But then I also have the individual funds where I'm making some passive income through my dividend paying stocks. Why do index funds and ETFs reign supreme over mutual funds on average? It's because of two things: the fees and the performance. Let's look at the fees first. And whenever I'm talking about the fees, I'm specifically talking about the expense ratio. Now, the expense ratio can cover a multitude of fees. Fees such as administrative fees, operating costs, commissions, advertising. These are fees that you will have to pay as an investor. On average, a mutual fund has a much higher fee and expense ratio than an index fund or an ETF that you're investing in. Mutual funds are actively managed by the fund manager, which means that the fund manager does all the research, the buying, and the selling of all the securities in that specific fund, and all the fees associated with the buying, selling, administrative costs, etc., even paying the fund manager's bonus, that's all being paid by you. Now, with a index fund or an ETF, those usually track a underlying asset. So for example, if you're investing in an index fund that tracks all the companies in the S&P 500, the fee is going to be a lot lower because all that fund does is mirror all the companies in the S&P 500. When you look at a mutual fund, you could easily see fees in the 1% or even higher. But when it comes to index funds, you can see fees that are 0.1% or even lower. And yes, even if a fund performs well, your fund went up 8% in a year, 10%, you would still have to take into account your expense ratio fees into your capital gain. And the second one, performance. Now, it has been noticed that mutual funds in the short term are able to outperform index funds and ETFs. But it's also been noticed that in the long term, index funds and ETFs that are being used as the benchmark, so for example, an index fund that mirrors the S&P 500, over the long term, those have widely outperformed mutual funds. And then even if you look at the mutual fund, tack on that expensive expense ratio also. When it comes to bond investing, all you have to think about it is as you're giving out your money and you're getting interest payments back, and at the end you get your invested capital back. So a corporation could go the stock market route in order to get money and do a initial public offering, or they could also go the loan route, and even a governmental institution. So with a governmental institution, for example, you give your money out to them, your capital, and they will tell you, okay, I owe you. So I'm getting your capital. While I'm holding on to your capital, I'm going to give you interest payments on a frequent basis, once every 6 months. And then I'm going to give you your invested capital back at a specific date, also called the maturity date. And some of the bonds that you can invest in are going to be your corporate bonds, governmental bonds, municipal bonds, which is going to be your local government, and the list goes on. Now, I like investing in a bond fund because when you invest in a bond fund, you don't have to do the research on which bonds to invest in because, yes, it's exciting to invest in individual stocks because you're doing the research and you have the hope that the stock that you're investing in is going to shoot through the moon and make you a lot of money. But with bond investing, it's a lot more stable, it's a lot more risk averse, it's more of a fixed income asset, so it's a lot more boring. When it comes to investing in bonds, I like the bond fund because I use it as a way to make passive income. On a monthly basis, I get my interest payments from my bond fund. Now, if you invest in individual bonds, you get paid every 6 months. But with a bond fund, because the bond fund is invested in so many different bonds, some of those are hitting the maturity date, Some of those are hitting an interest payment date, so you're constantly getting paid interest on a monthly basis. And then also, if you invest in individual bonds, there will be a maturity date where you will get your invested capital back. Then you have to take that capital again and then invest it in another bond. But when you invest in a bond fund, you will never have to worry about that because some of the bonds mature and then the fund manager is already invested in different bonds. So you can just hold on to your bond fund and use it as a passive income stream. So I like investing in individual companies, but I also keep my eye on some of the great index funds and ETFs that are out there because it makes my investing life easier and simpler. So if you enjoyed this episode today, go ahead and like and subscribe, and I'll talk to you guys in the next one.